Welcome to the weekly market wrap-up and our year in review special. I'm Hannah Bernard. Well, 2013 has come to an end, and wow, what a year it's been for the stock markets. There's been highs and there's been some lows, but this roller coaster ride has mostly hit record-breaking highs throughout this year. 2013 equities markets produced record-breaking moves. The Dow Jones is ending the year up around 19% overall from the beginning of the year, while the S&P 500 is up nearly 24% year to date. Both large cap indices broke new ground, with the Dow eclipsing the 16,000 mark and the S&P taking out 1,800 points in late November. Over to the NASDAQ Composite Index, the strongest performing index of the three majors this year, is up over 30% year to date and has been trading above the 4,000 point level, a threshold not seen since tech bubble days. So what's been driving most of the market action this year? Well, number one is certainly the impact of and speculation around the Federal Reserve's $85 billion a month bond buying stimulus program. As a market driver, it seemed at times this year that good news was bad news and bad news was good news. This seemingly illogical sentiment arose from the speculation that if enough economic metrics trended positively, the Federal Reserve would begin to cut down on its massive quantitative easing program, which has been artificially propping up the record moves in equities, so markets then dropped. However, if economic data suggested the economy was stalling and that more central bank help was necessary, then markets rose, as FOMC meeting minutes confirmed that the Fed chairman Ben Bernanke was more than willing to keep the monetary spigot open. And on December 18th, the Fed did just that, slightly tapering off QE by $10 billion a month, dropping it to $75 billion, and also extending low interest rates much further than expected. The Labor Department's monthly jobs report was a key focus for economists and traders alike in 2013 and played a key role for this year's volatility. For most of the year, job numbers appeared either grim or stagnant. However, late fall rebuffed the trend, producing surprisingly above expectation job numbers, with October and November outperforming forecasts. This is good news, or is it? Some analysts criticize the quality of jobs created, arguing that low salary and seasonal positions were distorting the true realities of the labor market. Acrimony in Washington played a critical role in shaping this year's overall economic landscape, as squabbling over the federal budget and debt ceiling extension brought the government to a halt for the first time in almost 20 years. In October, the Republican-controlled House forced a 15-day government shutdown by refusing to enact legislation to appropriate funds for the fiscal year of 2014. During the shutdown, approximately 800,000 federal employees were furloughed, leading Business Roundtable President John Engler to make the remark, "The government shutdown and the flirtation with default have dealt a severe and entirely avoidable blow to America's reputation around the world, while harming economic growth and job creation." Currencies for 2013 sang a volatile tune. Let's find out what happened this year in currencies. Volatility was the theme of the year as the US dollar index reached a peak of nearly 85, while hitting a low of 79 both in February as well as in late October. Much of the reason had to do with trading sentiment, as the investment community frustratingly played along with the coy FOMC meeting minutes and often ambiguous and conflicting remarks from Fed officials. The Japanese yen was the most talked about currency of 2013, as the yen index lost 15% of valuation year to date. This was a direct result of an aggressive monetary policy set in place by the Bank of Japan as part of the newly elected Prime Minister and his pledge to rid Japan of nearly 2 decades of stifling deflation. This boosted Japan's exporters and large cap companies, which rocketed the Nikkei up 47% year to date. The euro currency was one of the most sharply volatile, as traders absorbed both dovish and hawkish remarks from the European Central Bank president. Also, the divided nature of the European region, highlighted by the record-breaking move in the German stock market and also being weighed down by stubborn employment rates in Spain, meant that the market participants never had a dull moment with the euro. Let's turn now to winners and losers and our picks for 2013. The winner for this year is Best Buy, ticker symbol BBY. After being one of the worst performing companies of 2012, when stock valuations dropped 48% and bankruptcy rumors were rampant, Best Buy staged one of the most remarkable comebacks of 2013 and is currently trading up 256% year to date. Both fundamental and technical factors were at play. The management team refocused their marketing and advertising efforts, while technically bearish trading activity all but exhausted itself by December of 2012, allowing for the bulls to push the stock dramatically forward. Also, consumer cyclicals became the best performing sector of the S&P 500 later in 2013, and Best Buy was clearly a beneficiary of the increased confidence in the retail sector. The loser for this year is Penney, ticker symbol JCP. We covered Penney quite a bit this year actually, featuring them as a winner mid-year and then dropping the company down to a loser later in the fall. Unfortunately, the rise in investor confidence in the retail sector did not impact JCP. In fact, consumer spending could not help Penney investors out of their bind, with their stock easily the worst performer out of all the S&P 500 companies in 2013. Chaos in management, as seen by multiple swaps at the head office, combined with the dismal sales in an extremely competitive industry, made for a compelling case of imminent bankruptcy. While such fears are allayed for now, Penney was forced to squeeze margins to stay afloat this holiday season, and bearish activity abounds on the trading floor. Although JCP is expected to be around next year, needless to say, its long-term prospects are extremely doubtful. It was opposite of record-breaking highs for precious metals this year. Gold and the mining industry were amongst the worst hit commodities in 2013, with the yellow metal down 27% year to date. A lack of inflationary fears, which was a key driver in its prior bull runs, was cited by experts as a pivotal cause for its downfall. Growing consumer confidence combined with the specter of Fed tapering led many investors to seek safety in other alternative assets. Also, rising import taxes in India, the world's biggest consumer of gold, contributed to a decline in overall demand. Silver bullion took an even heftier fall than gold, dropping nearly 36% of valuation year to date. Like gold, the lack of inflationary fears quelled investor enthusiasm that viewed silver as a cheaper alternative to its more expensive cousin, while demand from its industrial component also fell. Palladium was the only asset that bucked the trend of heavy losses within the entire metals complex, which is currently trading near parity with its opening session. Its outlook for 2014 remains positive despite the turmoil for the rest of the precious metals, primarily due to the supply disruption concerns in South Africa and Russia, which are the world's top producers of this rare element. And that wraps up 2013. Thank you for joining us for another edition of the Weekly Market Wrap-Up and the Year in Review special. Be sure to join us next week for our first video of the new year. We'll be back with Bay Street's look at the week ahead and our thoughts on what to watch for 2014. From all of us at BayStreet.ca, Crush the Street, and Viral Network News, we wish you a Happy New Year.